Good afternoon, everyone, and welcome to our fourth quarter capital markets webinar. My name is Jason Symoniak, and I'm a senior analyst in the Global Strategies Group here at Manning & Napier. I've been with Manning for over a decade, and today I'm glad to be joined by Marc Bushallow, the managing director of our fixed income group and a member of the investment policy group here at the firm. For those unaware, we do this capital market update each quarter. In each quarter, we welcome new attendees, both to us as a firm and really to our way of thinking about the world. So as a brief introduction to Manning & Napier, we're an investment manager headquartered in Rochester, New York, managing well over $15 billion in client assets. We invest those assets across a wide range of products, including multi-asset class strategies, equities, and fixed income. Our fundamentally driven, bottom-up, multi-asset class portfolios turned 50 this year and are built upon a foundation of our disciplined processes, our investment strategies, and our risk management frameworks. So I guess to give you guys a bit of an idea of kind of where we're going today, our plan is to proceed as follows. First, we're going to talk about what we saw in 2022, and then kind of get into the outlook, both for markets and for the economy moving into and through 2023. From there, we're going to briefly discuss performance in 2022. And after that, we'll provide some color on the liquidity environment as we currently see it, and kind of how we think it's going to evolve from here, because that's a topic that we've gotten quite a few questions on over the last couple of days. And finally, at the end, as time permits, we'll be able to take some questions that come in during the presentation. As always, we're not going to be walking through our views on each and every sector and different asset classes and different stocks that we own. Instead, we're looking to take kind of a step back and give a broader perspective in terms of what we're seeing driving the markets today and where we think we might ultimately be going from here. So if you have any questions at any time, please feel free to use the chat function, submit them. We'll do our best to get to as many as we can while still being respectful of everybody's time. And at the end, if you asked a question and we couldn't get to you, we'll make sure that somebody reaches out to you. So, Marc, before we get to performance in 2022 and kind of talking about where we see things developing from here, I want to take a step back, kind of take a broad view, and just ask, when you look back at 2022, when you think about the year, what is it that really stands out to you? And what do you think you're going to remember?
I think for me, 2022 is the year that the everything rally turned into the everything sell-off. And people believe that 60-40 is broken. I guess the bad news of 2022 probably leads to happier news of 2023, as it puts us in a better place to earn returns. And I do think that the protections and the correlations that had made 60-40 such an attractive portfolio for so long will be back to the market going forward.
And it's, for me, I know when I think about 2022, I think the word that I keep coming back to is change. It's the year that kind of the bull market came to an end, growth's leadership yielded to value, and monetary policy changed dramatically. We went from monetary policy being this incredibly strong tailwind to markets to the exact opposite, right? It was a stiff headwind that really complicated performance across asset classes for most of the year. And that kind of brings us to where we are today. So maybe looking more at the economy than markets to start, where do you think we are right now?
Yeah, it's a difficult question. A lot of cross currents in the data. A lot of people are taking a lot of comfort from the strength we're seeing in production and employment. I would actually say, to take a step back and how do we think about the economy? We're not focused on whether GDP is going to be 1% or 3% next year. We're focused on where are we in the cycle and how are we progressing through the cycle. Punchline to that is it's late in the cycle. Look, as you can see from here, the leading indicators are following things like the yield curve, housing, new orders, all those things have shown pronounced weakness already. Banks are tightening lending standards. Consumers are starting to borrow on credit. All those are late cycle phenomena, as you see. The fact that things like production hasn't started to turn down until just recently and employment remains very strong doesn't surprise us. Those are coincident or lagging indicators that you wouldn't expect to fall or expect to turn until much later in the cycle. So we do think this is progressing through, as it may sound odd given how abnormal the past several years have been, but this is progressing like the most textbook ordinary cycle that we've seen in a very long time.
Yeah, and you mentioned some of, I guess, the divergences that we've seen in the economy so far. how some of the more coincidental indicators have held up, while some of the more leading indicators have certainly broken down. I wonder if you could go into that in a little bit more detail, maybe specifically talking about where we've seen some of that weakness, where we've seen some of the strength, and kind of what we can expect from here.
Yeah, so when we look at the data, a lot of the hard data, so again, things like employment and production still remain buoyant, very, very positive, leading you to think that maybe growth in the outlook can be much better. Where we've seen a lot of trouble is, again, you've just raised interest rates 400 basis points plus in the past year. So that's hit a lot of the interest rate sensitive parts of the economy, like housing. Obviously, the next thing is new orders have come down. Eventually, once new orders are weaker, and that shows up in survey things more than it does in hard data like production. Well, if you're a business and your new orders are coming down, the next thing that happens is you produce less. If you start producing less, you then will have less employees going forward because you don't need as many of them. So again, while it may seem that a lot of the hard data is still very supportive of a better economic case, this is the order that these things typically progress in a cycle, and it's right in line with sort of how we would expect those things to evolve.
And I think that's an important point too, especially when you think about the more recent periods of economic weakness that we've had, right? You think about 2020, you think about the great financial crisis, and these were very acute periods of weakness where things got very bad very quickly. And it's easy to be colored and kind of biased by those events or occurrences because they're what we saw more recently. But when you look back, take a broader, kind of more historical view at previous downturns, I think the point you make is exactly right. This is progressing the way that cycles have progressively moved and kind of what you'd expect. And the fact that those interest rate sensitive parts of the economy are the ones where we're seeing the most pain is exactly what you'd expect given the hiking cycle. So I think before we move on, maybe one more thing I want to dig more deeply into is the labor market specifically. Do you have any comments, or can you tell us kind of what you're seeing there?
Yeah, so obviously the labor market's very important. Federal Reserve, the tightness in the labor market is one of the things that even as inflation has showed some signs of softening, they remain very focused on. I think, what may be different when we look at the labor market this time around, what we had a scarcity of this time around was actually lower skilled, lower paying jobs that we couldn't fill largely in the services type sector. And really most of the layoffs that you've seen so far are actually white collar, higher paid jobs. You've seen every tech company on the planet seemingly have a layoff announcement, a second layoff announcement. That was where all the capital flowed. That was where all the hiring occurred. So this may be what will be different is a white collar driven increase in unemployment. Now, eventually, as production gets cut and companies need to cut employment, you would see unemployment occur in the lower skilled, lower income part of the economy. Well, but usually they take the brunt of it, and the brunt of it may start more in the white collar sector this time around than what we've historically seen.
Yeah, that's a good point too. And I would expect, given the way that consumption drives the US economy, we've started to burn through some of those excess savings that we built up as a result of fiscal stimulus during COVID and kind of the quarters and years that followed. Having burned through that, as we start to see labor markets deteriorate, which we anticipate will be the case, I think it's going to be more clear that we're heading for, an economic backdrop that may not be as durable or as strong as it seems right now. So that's going to have obvious implications for inflation. Inflation was topic 1, 2, and 3 last year. And I think we'd be remiss not to talk about it kind of upfront when we're addressing our economic outlook for the year. So I'm wondering what observations you have about inflation and kind of what you can tell us about how you see it evolving from here.
Yeah, it has been the key topic that everybody, including the Fed, is squarely focused on. I guess on the good news front, look, the past couple of inflation prints have been softer than expected, more in line with sort of 3 to 4% type inflation on an annual basis. When we think about inflation, break it down into a couple of components: goods, commodity-based inflation, and service-based inflation. Look, the thing that was different this time around was on the goods part of the economy. Historically, goods have had an inflation rate of roughly 0 over time. Obviously, during the pandemic, you had both supply challenges with the supply chains, and then you also had, excessive demand. The government sent out a lot of money. People couldn't go to restaurants. People couldn't do services, so everybody bought stuff on Amazon. So you had this huge amount of demand for good at the same time that you had supply chain issues, and you had goods inflation get to double-digit levels. Well, that's already receded. So that's come down. Commodity-based inflation, which was negatively impacted by the war in the Ukraine, that has come down significantly off the peaks. Look, on the services side, and that's the stickier component that you see in the chart that drives a lot of that. Services is driven by wages. There has been what is arguably some comforting news. To me, the fall in average hourly earnings, if you compare that to sort of the Atlanta wage Fed tracker, which is a more like-for-like measure, indicates it may be more mix shift. Again, you've seen a lot of white-collar layoffs, which are very high-paying jobs, and a lot less layoffs in the lower income sector. So I don't know that the underlying push in the service sector inflation is subsiding yet. That remains to be seen. The good news is inflation is coming down and at a relatively rapid pace. I think the tougher news for investors may be, well, 2022 was all about inflation. In 2023, it may be all about growth, where inflation becomes less important as the growth outlook becomes more difficult.
Yeah, I think if I was going to add anything to that, what I might say is very simply, where we've seen inflation roll has kind of also been where we've seen the good side of the economy start to slow. We've seen the good sides of inflation start to slow. At this point, I think the thing that's problematic for the Fed is that services inflation it has proven to be sticky, and I think that may continue to be the case, which means the Fed certainly isn't done from here, right? So when you look at market expectations for the Fed, maybe two questions here. How do you think the forward curve is priced relative to how you see things evolving? And then I guess how high ultimately do you think the Fed is going to go?
Those are the million-dollar questions. Look, I think the Fed's been fairly consistent with saying they need to be higher for longer. At this point for the Fed, it's all about credibility. Well, ultimately, the goods part was transitory. Inflation itself has not been transitory, so their credibility took a hit and they let the inflation genie out of the bottle a little bit. They're very determined not to make the same mistakes that they made sort of in the 80s, where they let off the throttle too quickly and then had to step back on it. They've been very cognizant that occurred, and they want to make sure that they fully snuff out the inflation so that it doesn't come back. So for them, it's about credibility, which argues they're going to stay a moment too late and not leave the party too early this time. So look, they seem pretty intent on getting rates up to a level that they deem restrictive, which is sort of in that 5% area, and maintaining it there. I think what you're seeing in the forward pricing curve is not necessarily the market's base case, where they think the Fed's going to hike to 5 and then it's going to cut a couple times. I think it's a more probabilistic view of the world, in that one scenario is a soft landing where the Fed is able to get it up there, hold it there. There's not, the underlying strength in the employment market holds, and you get that magical soft landing. But another scenario is the Fed gets it up there, holds it there, and we have a recession, then they actually have to cut rates pretty significantly. To me, you're going to see either no rate cuts or a fair number of rate cuts as we have pronounced weakness in the economy. And I think the market pricing is, people trying to probabilistically weigh those outcomes over the market thinks we're going to go up and just come down a notch.
So I really like that point. I think it's easy to look at the forward curve and say, okay, the market's pricing in, 2 cuts next year, back half of the year. It seems really unrealistic to me that we get into such a scenario where inflation would come down so quickly, the economy would slow, but not that much. And the Fed would think, okay, we can cut twice now. I think what you're saying is that's kind of the wrong way to think about what you're looking at. What you're actually looking at is kind of the mathematical outcome when you compare those two very different outcomes that you address for us. So I appreciate that perspective a lot. Moving on from there, one of the things that really stands out to me is just how inverted the yield curve is right now. But I think you're as well positioned as anybody here at the firm to really speak to what you're seeing when you look across the yield curve.
Yeah, so look, the yield curve has been the greatest economist. It's predicted 13 out of the last 9 recessions, which sadly is better than most economists. But it is one of the best indicators that there are out there. Look, early in the year, people got real technical. This part of the yield curve's inverted. That part's not. What does it mean? The whole curve's inverted. That's not really the debate at this point. 2s, 10s, 5s, 30s. T-bills over the 10-year, whatever your favorite measure is, it's inverted. To me, though, the thing that's changed is for the first 3 quarters of the year, the yield curve was inverting because the front end was going up fast, but the back end was still going up because inflation was still missing to the upside, and people were still pricing in higher levels of growth and inflation over time, but they were pricing in the Fed hiking at an even faster pace. What you've seen in the fourth quarter is obviously the front end has stayed up because the Fed is still going to be increasing rates, albeit at a slower pace, but the back end has started to come down. And to me, that is actually people are bringing down inflation and growth expectations. So to me, that is the more worrisome signal that now that you're starting to get weakness in the back end while the front end staying up, that the market is more implying a recession than maybe earlier in the year when it was really just the front end was racing up much faster than the back end.
Yeah, I appreciate that, Mark. Thanks a lot. And I guess sticking with the point that you just made, or I guess the theme of kind of what you were saying at the end there, looking at what the market is telling us, it's interesting that it stands out to me that different parts of the market are sending different signals. And I think that that's telling you that maybe the consensus opinion about a recession or economic weakness might not be as priced in as people seem to think it might be, given the pain we saw in financial markets last year. And I think the high yield index, the high yield spread, is a good example of that.
Yeah, and so the nice thing about looking at the fixed income is it doesn't require the level of interpretation that maybe an equity multiple may be on what are people pricing versus multiples, interest rates, earnings. It's just a straightforward number. So the spread is just the extra premium you're getting above a comparable maturity treasury to compensate you for the fact that you're holding a credit instrument. When you look at the high yield market, historically 300 basis points or an extra 3% is telling you the sun's out, the world's great, this is as good as it gets. And when people start to price in a recession, you get to 1,000 basis points or 10% more than an underlying treasury, telling you that defaults are going to be a double digit and the world's going to be pretty bad. The high yield market's been right around that 450 basis point in spread mark. And to me, that's not telling you that people have much fear of a recession priced into the market. That's much closer to that 300, the sun is out. You're not really getting paid a lot for the risks of a downturn should it occur. And look, the high yield market isn't a cherry picked data point. I would say the same thing about the investment grade market, the securitized side. You're getting the same message from the credit markets that, yeah, it's pricing in that there's been volatility, but you've not seen a material concern over actual defaults in those types of risks. I think the equity markets are probably pricing in a similar story, but you're in a much better place to comment on those than I am.
Yeah, so I think before we get to the equity markets, I want to move to kind of broad positioning for the coming year. But even before we do that, I guess I just kind of want to briefly recap what the outlook that we're trying to communicate is. At this point, our base case is that a recession in the US is likely, right? That doesn't mean that it has to be a deep recession. It doesn't mean it has to be a prolonged recession, but we do think a recession is likely, right? And even absent a recession, it seems all but certain that growth is going to have to come down from these levels, right? You've got a slowing economic backdrop. You've got inflation starting to roll. These are things that we have to consider in terms of positioning, both right now and as we move through the year. So with that kind of being said, Mark, maybe we'll start with bonds before we get to equities, and you can kind of talk about the starting point and what it is you're seeing, and I think maybe how you guys are thinking about positioning from here, if you don't mind.
Yeah, great. Thanks. Look, 2022, I think the only word that can to describe it in fixed income was painful. It was one of the worst drawdowns you've seen, if not the worst drawdown in the history of broad indices like the Barclays aggregate. The good news is your longer term returns in fixed income are heavily influenced by the starting point or what kind of yields you get. So a year ago, it may sound odd to remember this, but in December of 2021, the Fed affirmed 0 to 25 basis points as the range for the federal funds rate. Obviously, we're above 4% at this point. So we're in a very different starting place. Nobody liked trying to earn returns when yields were 1% because your long-term return expectations from there were not good. What this chart shows is that along the bottom is the starting yield to worst of the Bloomberg Barclays aggregate. So if you have a starting yield of, call it 4%, your 10-year expected return from fixed income is roughly 4%. So the good news is, while that adjustment last year was very painful, given that we have a much more attractive starting level for yields, we expect clients to be able to actually generate much higher returns and meet their objectives in fixed income. You got to remember, at 1%, every dollar, even if it looked great on your statement because you had that capital appreciation in all your bonds, every dollar of income in principal that you receive back, you're only reinvesting at 1%. At 4%, every dollar of income in principal, you're now going to get 4% when you're reinvesting in that. So in any given year, obviously you'll have a capital appreciation, depreciation on top of the yield component, but over long horizons, your returns are largely dictated by the starting yield in your fixed income portfolio. So the outlook is much better now than it has been in some time for the fixed income markets.
Yeah, and it's interesting. When I go from fixed income to the world of equities, I think the first thing that stands out when you look at a chart like this is it's easy to see, especially with hindsight, that we entered a period where valuations just got incredibly frothy, incredibly bubbly, and it was due at some point to change when a catalyst for such a change was provided. And I kind of started with that word change and talking about 2022. And indeed, when we got that, we saw that dramatic pullback in equity markets. I think the thing that I kind of struggle with now when I think about potentially allocating to equities, especially when I look at the broad market, is that while valuations have pulled back, the market is not cheap yet, not by any stretch of the imagination. Like we're kind of back to more long-term averages on a chart like this. And the thing that's worrisome to me is we're looking at kind of more neutral valuations set against a backdrop of earnings expectations that really haven't come in significantly yet. When you look at past periods of economic weakness, you tend to see double-digit drawdowns in forward expectations for earnings. And while we've seen earnings expectations roll, we're certainly not to a point yet where we've seen those double-digit drawdowns. And when I look at fairly neutral valuations set against the backdrop of earnings expectations that I think have to come down, the market just isn't that cheap. Now, that's not to say that there's not certain industries and certain sectors where earnings estimates have been absolutely slashed. The median stock has come down significantly more than the headline index might suggest. So there are absolutely areas of the market where we're seeing opportunity, but broadly, it still doesn't feel like that time where you kind of want to start getting towards the all-in moment in equities. So when I think about asset allocation at the firm, we tend to talk about moving from cash to bonds to equities back to cash. And what you said about bonds really stands out to me. Now, I think despite what I said about equities not being quite there yet, the fact remains that when you look at past drawdowns, when you've seen these periods of pain, forward returns do tend to be attractive. Now, that doesn't mean that they have to be now. It certainly doesn't mean that they will be now. But I think the thing that it does mean is that it makes sense to be looking for new areas of opportunity in the markets. And I think one thing that stands out to me is we talked a little bit about growth versus value. We talked, there are different types of investments that perform well at different parts of the cycle. And I think coming out of this, you're going to see us looking at parts of the market that maybe we haven't looked at in quite some time, right? So when we were in a late cycle environment, kind of those larger cap, growthier, more profile type stocks, which is our language for strong businesses, strong competitive positions. They earn fundamentals, they generate fundamentals that are stronger than competitors. We tend to own a lot of businesses like that later in the cycle. Early cycle, you're going to see us looking at potentially more cyclical industries. And as an example, we bought semi-cap stocks not that long ago. Industries exposed to something like the housing market might be significantly more interesting to us in the coming months or quarters than they have been in the past. So Mark, I don't know if you have anything to add to that. If not, we can kind of move on to a performance recap for 2022.
Yeah, I think I would just highlight a couple of great points that you made. We talked about whether or not there's going to be a recession. And while our base case is that you have a downturn, I think more importantly, where there's conviction is the corporate profitability is going to be pressured because a lot of those factors and drivers are already baked in the cake, so to speak. So obviously, again, that presents a challenging environment for some of the risk assets like credit and equity. And then, with respect to the drawdown, look, we're not in the business of trying to call the bottom on the day to put it in. I certainly think we've been underweight equities relatively materially this year. But to the extent you saw further weakness in the equity markets, at the investment policy group level, you're likely to see us to start encouraging bottom-up analysts to find more names, more ideas, and to start taking our equity allocation up. That isn't us saying that the next drawdown's the end, the last, nobody knows when that day is, but you're starting to get to the point where we want to be buying and adding into whatever the ultimate bottom of the market is.
Yeah, and I think the point you made on corporate profitability is so important because whether or not we're right or wrong about the recession, I get back to the idea that the economy is slowing, which is going to be a headwind to top line revenues. Inflation is rolling, which is going to be a headwind to nominal earnings. And margins are still going to be pressured. And that type of environment is going to be really difficult for corporate profitability. So I really appreciate you going back, highlighting that point. I think from here, we're going to move to performance, Mark. So maybe if you can tell us a little bit, just kind of what you saw or what we saw across asset classes last year, and then maybe specifically kind of what it meant for some of our multi-asset class strategies.
Yeah, unfortunately, what we saw across sort of asset classes everywhere for the year was a very difficult year. Again, last year was the year that the everything rally turned into the everything sell-off, and 60-40 sort of broke, and that you had losses in both equities and the fixed income markets. You had a nice reprieve from that in the fourth quarter, which a lot of that had to do with the starting point is obviously the end of September, you had the ramp in interest rates as well as the pretty nasty sell-off in equities in September. So it was a very difficult year for the markets across the board. When we take a look at what does that mean for the performance that we were able to achieve for our clients, to me, I think about this in a couple of constructs. The way that we've been able to meet our client needs over long periods of time has been through our process. We're very process oriented to make sure that we're doing the right things for our clients at the right time. And that's able to generate those very attractive long-term returns for them to be able to meet their needs. The asset allocation is actually something that we got right in 2022. We were underweight equities for most of the year. Unfortunately, that had a much more limited effect than it normally would have, because obviously the difference between equity and fixed income performance, even in a very difficult equity tape, was not as much as you would typically would have expected. On the fixed income side, look, we were able to add relative value, meaning that we outperformed the benchmark, but that still meant material and real losses in an absolute sense. And there were some areas of bright spots that helped us there. Our allocation to high yield, the asset class performed well, but our strategy also had significant value added or alpha on top of the asset class, which helped our clients. And then our allocation to unconstrained, which we think is a strategy that's going to be very important as a part of our fixed income portfolios in our multi-asset class going forward. It's a more go anywhere, do anything strategy that lets us be more adaptive to the environment than sort of a typical aggregate type strategy. And look, on the equity side, you talked a lot about the profiles, the stronger businesses, which is where the bulk of our equity is held. Look, a lot of the things that did really well last year, such as energy, those are more the cyclical, the hurdle rate industries. And we always want to be early into those and building our position as, sadly, pain attracts us to those industries because we know supply comes out, which sets the stage for a happier day. But also importantly, when the sun's out, you have to sell in those things because there will be that bad day after that. And we typically exit those things early because, again, we don't know what the top tick is. We just know that conditions are setting up that the future will become more difficult. So, we had a lot less exposure to a lot of the cyclical things, but that's tipped right in line with the way the process has allowed us to generate returns for our clients over time.
Yeah, and I think the thing that's worth pointing out from my perspective, kind of along the lines of what you were saying, is if you look at the way that our equity portfolios are constructed in terms of our equity strategies, we tend to own more hurdle rates, which are in very cyclical industries, like you alluded to, early in the cycle. When we've seen significant pain, we try and be early to those, like we were in 2020. We own those, and as things get progressively better in that industry, we want to exit that. Now, what that means functionally within the portfolios is that the number of hurdle rates we own falls and the number of profiles we own tends to increase with time. And this ebbs and flows. It isn't a hard and fast thing. But if you don't own something, you have to own something else, right? And maybe the thing that was somewhat surprising to us was just the rapidity with which we moved from early cycle to mid cycle to late cycle, from 2020 to 2021 to 2022. And when you think about those profile type companies, those have kind of been our secular growers over time. And unfortunately, names like that are the ones that were hardest hit when the Fed started to hike rates really quickly. And I think, for better or worse, clearly for worse in this case, that's really what drove a lot of the performance that we saw kind of within the portfolios. And talking specifically about that divergence between growth and value that we've kind of alluded to, I think when you look at the performance of some of our more niche products, again, that's borne out in what we saw throughout the course of the year.
Yeah, I agree. And I think this is a good point to come back to. You mentioned at the beginning of the presentation change. And I think these two products are uniquely positioned for, look, there's a lot of changes in secular forces that may make investing in the next decade very different than what we saw in the past decade. And to us, those favor two types of things. One is sort of higher yielding, shorter duration type assets. Well, that sounds like a fixed income turn. We're talking about assets in general. So something like disciplined value, which had a really good relative year, as well as good longer term track record, is well positioned for that. And the other is, strategies that generate a lot of alpha. And so something like our international small cap strategy, yeah, it had underperformance last year, but you can see over long periods of time, there's a significant amount of alpha from manager skill that's been exhibited there. So we think those are two types of strategies that in the forthcoming 5 and 10 years, which may be a very different investing environment than the past 10 years, or quite frankly, the past 40 years were really just all about beta, whether it was fixed income or equities. You had falling rates and falling inflation, which provided a tailwind. We do think those types of investments are well positioned to succeed in the next sort of 5 and 10 years.
Yeah, it's really interesting, Mark. I appreciate that. So before we get to kind of the more live fire Q&A section of this call, we do have the ability to take some questions kind of before we start. And one of the topics that really came up a lot that I think fits well into the discussion that we've had so far is really on liquidity. So I think the two things I want to talk about before we get directly into the Q&A are the Fed's balance sheet for one, and then kind of what that plus the rate hikes that we've seen have meant for money supply growth here in the US, but also, also broadly, given kind of the size and the scope of the US market. Maybe I would just turn it over to you, Mark, and kind of ask you to comment broadly on what we saw from the Federal Reserve in terms of kind of the massive expansion of their balance sheet, what we've seen since then, and maybe you can comment on their ability or potentially even their inability to shrink their balance sheet from here and what it might mean.
Thanks. Yeah, I spoke earlier about sort of the everything rally and the everything sell-off, and in a lot of ways, those are reflective of the liquidity environment in the markets. So, if we go back to 2020, as painful as it was for those 20 days or 22 days that the sell-off occurred, what followed was a massive amount of liquidity from the Federal Reserve, which at least initially was necessary. The markets were not functioning full stop. We had a hard time selling anything other than short to intermediate treasuries, which is sort of unheard of even in very difficult times because things were so uncertain. So they did a great job of sort of, stopping the seizing up in the market so that things could function. But then they kept buying $120 billion worth of securities a month for, arguably that was the mistake they made, is even after unemployment came down, even after things were clearly back to a more normal state, if you could call anything that's occurred over the past few years normal. They kept buying and providing huge amounts of liquidity. And obviously at the same time, there was a ton of money being transferred from the government to consumers. And that wasn't, the things we're talking about were not just US phenomena. This was going on globally, where people were providing as much liquidity and as support as possible. That massive wave of liquidity was a lot of what led to the everything rally that we saw in 2020, 2021. We're on the other side of that. Yes, the Fed's raised rates very aggressively, but people kind of forget in the background, they're shrinking their balance sheet $95 billion a month, 60 billion in treasuries, 35 billion in mortgages, which is over $1 trillion a year. and balance sheet shrink. Now there's a limit on obviously how far they can take that down. And I think this chart right here is probably the best way to why does all this matter. M2 growth exploded to something like 25% at the height of the pandemic in the largest. And, we're back down to zero, and it may well go negative very shortly. So clearly liquidity, which was sort of the wave that wrote it all up, is now also we're on the downside of that wave as well.
I guess two observations. I mean, the first is that even if you take that chart on a longer term historical perspective, the move that we saw in 2020 was just incredible.
Yes.
That money had to end up somewhere, and it's not necessarily surprising in hindsight that what we saw. I think if I want to take a more positive spin, the decline we've seen from the peak is also just incredibly sharp, incredibly violent, and the magnitude of that move is enormous. That move is now behind us, right? We don't need to go to negative 25% year-over-year growth to compensate for what we saw. So the idea that things have to get materially worse from here because the Fed is continuing to withdraw liquidity might be misplaced. Maybe a better way to say that is that the worst of the move in liquidity, I would argue, is almost certainly behind us. Do you think you would agree with that?
I would agree absolutely on the second derivative, the pace of rate of change that we all focus on so much in the financial markets. Clearly, we're unlikely to get to minus 25% in liquidity, but it will remain a headwind in that the Fed is removing, $95 billion worth of liquidity a month for the foreseeable future. So the headwind remains.
So we do have some time left. I want to be respectful of people's time. I don't think we'll take it to the full end of the hour here, but we have gotten quite a few questions, and I've been trying to bucket them the best I can. I think what we're going to do is we're going to start in the US and really focus on some topics that pertain. It looks like a lot of them pertain to the economy. Some we've touched on, some we haven't. And yeah, we'll go from there. We'll start in the US, maybe move to investment vehicles, and then kind of ex-US if we continue to get questions along that front. So first question, Mark, why has the US jobs market been so resilient despite the fact that the Fed has hiked so aggressively? Does that mean we're heading for a soft landing?
Yeah. So again, that is, I think, the question of the moment for everyone, because employment has remained such a stable force and continues to remain very strong. I come back to that's actually what we would expect at this point in the cycle. Employment is the last thing to go typically in a cycle. So I don't think that that's indicative of anything. Obviously, it does provide support, and obviously the dynamics in the labor market are a little bit different this time around than in the past. So I would say that no, it doesn't necessarily mean that we're headed for a soft landing, but it's more typically how we expect to progress through a cycle.
Yeah, and I think maybe the thing I would add to that, we talked a bit about this earlier in the presentation, but I think it's easy to be colored by the last two drawdowns, the last two recessions that we've seen. If you exclude those and you kind of compare the unemployment rate in the US to past periods of financial tightening, typically you don't see unemployment rates start to rise for 4 or 5, 6 quarters until after financial conditions have started to tighten meaningfully. And keep in mind, the Fed hiked in March of 2022. So we're not even 12 months past that yet. So it makes sense that we're seeing what we're seeing, but what we're seeing now doesn't mean that things can't or won't get worse from here. So the next question, Mark, is with inflation expectations having come down, are you comfortable with the idea that inflation will be back within the Fed's target rate in the next year or so?
So I certainly think that inflation expectations have come down to a level that's more consistent with the Fed mandate. Inflation itself is likely to come down relatively rapidly. I do think that, getting to 3% is very different than getting to 2%. And I know a lot of people say, well, they should just accept 3%. Why, press on the economy, perhaps have more unemployment just to get it back to 2. And you're back to the credibility issue, because if the Fed says 3 is okay, not 2, I'm going to think, well, then 4 is okay, not 3. It's a very slippery slope. So I do think that they still have some work to do. Again, I think getting back down towards the 3% level is going to happen relatively rapidly as we progress through the year. I do think getting all the way back to their mandate because of that wage component, because of the services and the stickier inflation could be more challenging than maybe is widely appreciated. And I think that's a lot of the divergence you see right now between the market and what the Fed is telling the market.
Great, I appreciate it. So we talked a little bit about the credit cycle of the US, but maybe going back to that, what are your views on the upcoming credit cycle, specifically with regard to how it could impact the corporate credit markets? And we talked about this a little bit, so we can probably get through this one maybe a little quickly because we've got quite a few questions coming in.
Sure. I think, look, bankruptcies remain low. I would argue, much like our comments, leading versus coincident at the macro level, those are backwards looking. If corporate profitability is pressured, then obviously debt service and all those things are going to be much more difficult. So we do expect a typical default in credit cycle to play out as we progress through the next 12 to 24 months, which would then again lead to wider credit spreads than what we've currently seen.
So again, this is something that we've talked about a little bit, but this question kind of piggybacks on what you just said. Speaking to that point, how do you view the difference in what's being priced into the yield curve versus the corporate bond market right now? And what do you think that means for positioning within a fixed income portfolio?
So within a fixed income portfolio, we remain relatively conservative. The thing that we've become more optimistic about is actually the duration or the interest rate side, because while they've pulled back some, interest rates have gotten to levels that are actually attractive now, and we haven't seen in a very long time. But on the credit side, we just don't think you're getting well compensated for credit spreads. So obviously there are always individual names and opportunities that we find that we want to hold in our portfolios. But overall, I would say we've become much more optimistic on the duration side, and we still remain very conservative on the credit or risk asset side. We do think obviously at some point this year, if you have a weaker environment, the duration will do well, and then you'll want to focus more on the credit side where you're going to have a significant opportunity in the credit markets to lock in some really attractive spreads for a very long time.
Okay, so last question specifically on the US, I think. Typically things go wrong when excesses are rapidly unwound. Where do you see the excesses in this cycle?
So, I think the obvious excess, and it showed up in all the layoff announcements we're getting, all the capital, and it's not even really just this cycle, if you think of the cycle as 2 years, but for the past decade, all of the capital has flowed towards growth, technology, in those types of businesses. That's what's been in vogue. That's where all the capital's flowed. And I think you're seeing the other side of that is, a lot of these companies, VC companies, technology companies, are now laying off people in droves. I think the interesting thing on the credit side is private credit has become humongous in a heartbeat. And just to place that, it is now the same size as the leveraged loan in the high yield markets in the US. They're all roughly equally the same size. Look, private credit was typically, I need to borrow $25 million to buy out a chain of dentist offices or something. Now, a lot of private credit is, I'm going to fund this $2 billion LBO. So look, obviously it's very strategy specific, but that is an area where everybody raised $50 billion funds. A lot of money has flowed. I think it'll be very interesting to see how that plays out as that has to sort of grow up through a full cycle.
Great. So rather than pivot to investment questions, we've got a couple that have flowed in on the non-US side. And I think they fit in well to maybe where this conversation is going, Mark. So I guess I would ask you, do you expect the trade war to contribute more to inflation moving forward?
I think it's a great question. I'm going to pivot and answer it a little bit differently in that, I talked about there's significant longer term secular changes. And I think deglobalization is one of those changes. So it's not just specific to, say, a US-China trade war. I think it's a bigger trend that argues for higher inflation and higher rates over time. And I hate to say that given our current starting point, but I just mean as you go through each cycle, 2 becomes 3, becomes 4. I don't mean that 7 becomes 10, becomes 12.
Yeah, I like that answer a lot. And maybe I'll weigh in too, because it's something that we talk about and think about quite a bit. Very broadly speaking, I think that there's a lot of trends that have been occurring for the last decade plus that you can start to make a case are changing now. And that doesn't mean that it's changing for sure or that it will continue to change. But to me, especially when I look at past periods that were more inflationary, you tend not to see inflation spike really quick and then nicely come right back down to kind of the trend level it was at before. I think things like deglobalization, like rising geopolitical tensions, they have the potential to make the backdrop significantly more volatile than it has been in the past. So potentially we see spikes in inflation that may die out quickly because the supply chain gets gummed up or something like that, because, inventory can't be shipped to where it needs to be shipped the way it has in the past. And to me, that more volatile environment, I think it complicates policymaking and I think it complicates investing. And that's kind of one of the things that I'm thinking about from here. So we've talked a lot about kind of what could go wrong in 2023. What is it that you think could potentially go right?
Look, I think the most important thing was probably the most painful thing in 2022, that if inflation comes down rapidly and maybe gets down even further than we expect, yeah, there's an impact on the Fed, but on the real economy, there's an impact that people's purchasing power improves. So even if wage gains aren't what they were, look, when wage gains were 7 and inflation was 9, your purchasing power is actually falling. So if wage gains can moderate and you can get inflation back down to target, consumers' purchasing power can actually improve, which obviously to the extent a lot of that improvement is happening at the sort of lower skill, lower income, those people tend to have a propensity to consume of close to 1. And that would be sort of one of the benefits. The other thing is when I think about is whether or not the US is headed into the recession, the rest of the world, Europe, China has already been through or is currently going through a more difficult spat. That could take some of the edge off of demand that could help the inflation scenario in the US. So those are the two things that I think about that lead to a more happier outcome for the economy and the financial markets.
Yeah, and I might quickly say a couple things too to follow up. I agree with the idea that we could be in a different economic situation ex-US than we are within the US. And maybe to answer the question a bit of a different way in terms of what could go right in 2023, I think the thing that's interesting after the year that we saw in 2022, because of the pain that we saw, there are now parts of the market where there are opportunities to invest where maybe there weren't before. And in that case, it's almost less a matter of something going right or something going wrong, and more just the risk reward in different parts of the market is significantly more skewed towards the reward side than it was the risk side coming into 2022. So I suppose maybe that doesn't directly answer the question, but it's how I would think about it's how I think about it. So from there, we're winding down on time here. Mark, I think this is a good question to potentially wrap on. What vehicles do you suggest help clients invest their money with confidence in more of an uncertain and volatile environment that we've kind of laid out here?
Yeah, that's the $1 million question. And obviously meeting our client objectives is what we're here for. I think I would answer with a couple of different types of strategies. On the fixed income side, we talked about the next 5 to 10 years could be more rising rates and inflation over time. Something like unconstrained, which has the ability to be more dynamic and navigate that environment than sort of an aggregate type products that were the bedrock of the 60-40 for the past 30 or 40 years. I think it is a very attractive option. I think on the equity side, I would go back to the two sort of specialized products that we talked about on the return side. Something like disciplined value, that is that higher income, shorter duration type product on the equity side. Higher quality value, not just value, I think is especially well positioned for what's in front of us. And then something like the international small cap strategy, where there's just a ton of alpha, a ton of manager skill that's been exhibited over time. I think, again, those are the two areas that I would point at to be able to generate returns going forward, is either that shorter duration, higher yielding option, or those areas that have significant manager skill in the different
Right.
the niche parts of the market where you can add an awful lot of alpha.
So, Mark, it does look like we got one other question that I want to answer. And somebody wants to know if the Bills or Dolphins are going to win the coming football game. So I would preface this answer with the fact that one of us is born and raised in Buffalo, and, one of us potentially not. So we'll turn this over to Mark, then I'll come back with the right answer.
I'm going to answer this question with my wife is not only from Buffalo, but from Orchard Park. And both my kids love Josh Allen. That said, I grew up a Dolphins fan, and I'm pretty sure the Bills are going to rout the Dolphins badly this weekend.
It does not appear that I need to step in and give the correct answer then. I agree with everything you said. So I think with that, guys, we've come to the end of our time. First and foremost, I want to thank everybody for taking the time out of their day to be with us here today, especially after such a challenging year in 2022. If we didn't get to your question, we'll be sure to follow up after the presentation. And as a reminder, for your convenience, a recording of this webinar will be emailed to you pretty shortly. Please feel free to continue to reach out with any questions or follow-up that you may have. And guys, we'd also really, really appreciate it if you could take a few seconds to fill out the survey that we've linked in the chat. So Mark, I can't thank you enough for being here today. To our listeners, thank you as well. And guys, it's been great. Thank you.
Thanks a lot.